Welcome back to our third video on Chapter 6. Before we go any further, I want to remind you of the concepts we've covered so far. First of all, the blue line right here, whoops, there it is it's called the efficient frontier. Now, technically, and this term right here, min, is the minimum variance portfolio. So you can see that that would be true because when you come straight down here vertically to the x-axis, it has the lowest standard deviation of any portfolio on this entire line. Now, this line is constructed, the blue line is constructed of a two-asset portfolio. Here, we're at all stocks. Here, all bonds. Here, we're at all stocks, stock funds, bond funds. And when you combine the two, all points in between are combinations of bonds and stocks. And then when we get past the stock line, we're beginning to short bonds, all stocks plus some short on bonds. At any rate, below this level, the minimum variance portfolio, this is the inefficient frontier below here. And above that is the efficient frontier, is the term. And another important concept is this line here is called the tangency line. It is the capital asset line or the tangency line, and it is tangent to this curve, the blue curve. And at the point of tangency, where it intercepts technically at one point, that is called the optimal portfolio. It is in fact the optimal risky portfolio because it's made up of two assets, stocks and bonds. And both stocks and bonds carry some risk. Bonds are much less risky, but they do carry some risk. So you know that the risk-free asset, we're going to put right here, is treasury bills technically, and there's some other almost risk-free assets that we've talked about. So at any point on this tangency line between 3, where it intersects the Y, called the intercept point, and portfolio O, this O, optimal risky portfolio, as we move down the black line in this direction, we begin to add some percentage of mix with the optimal portfolio some risk-free asset. And this is subjective from an investor perspective of how low a standard deviation are they, what's the highest standard deviation they might be comfortable with. So the optimal portfolio has a standard deviation of 10%. Well, that may be too much variation for some investors. They're just not comfortable with that. They want less volatility. So you could add more risk-free to this optimal portfolio in order to soften up the volatility, to tame it down a bit. And so that is adding the addition of a risk-free asset to, in this case, a two-security optimal portfolio. And this line could be, and we'll look at later, efficient frontiers made up of more than two assets. So that's kind of a recap of what we covered in the last couple videos. So with this efficient frontier, I also want to remind you, and be sure to remember that the x-axis is standard deviation, the y is expected return. Okay, so that's going to have application, a little more application in a minute. Now, you'll probably be very happy to hear that you're not going to have to calculate complex mathematical formulas to get that efficient frontier or optimal portfolio or tangency portfolio. We've got software that's going to do that, and you guys are going to be able to use that in our project for this class. And when we run those numbers with software, there are 3 methods or maybe it's better to say 3 goals that we may keep in mind when we calculate our efficient frontier. One is we want to maximize the risk premium. You'll recall risk premium is the return in excess of the risk-free return on any portfolio or any security. The risk premium, that's That's the return you get for accepting the risk, assuming the risk that's inherent in a security or a portfolio above the return for the risk-free asset. So we can have the goal of maximizing our risk premium, which you may as well say the overall total return as well, for any level standard deviation. So we choose the level of standard deviation that we're comfortable with, and then maximize risk premium. I believe that the software you're going to use will do that. We can also make another second goal, or a different goal, to minimize the standard deviation for any level of risk premium. So we'll pick the risk premium and let the software find the combination of the assets that we choose. In our last example, it was stock funds and bond funds, and say, look, those are our two assets that we're willing to use. Minimize what combination of those minimizes a standard deviation if we require, say, a 7% return. And then the third goal we might have is to maximize the Sharpe ratio for any standard deviation or risk premium. You remember Sharpe ratio is really a benefit to risk ratio. It's the return of the portfolio less the risk-free return divided by standard deviation. So we can try to max, and standard deviation is risk. So that's the best. Sharpe ratio is return per unit of risk, we could say. So we can seek to maximize Sharpe ratio, and you're going to have an assignment that does that, and the portfolio visualizer software you're going to use this week will accomplish that for you. But we're learning all this so that you'll really understand what the output is telling you. That's why the goal here is to learn these terms, what an efficient frontier is, and so forth. So when you run a portfolio, you choose assets and determine the Sharpe ratio. Well, it's helpful to know what that ratio is telling you, right? What the information contained in it is. So this slide, again, remember, X is standard deviation, Y is return. And this slide is showing us that remember, the efficient frontier from this point above, that dot right here, is the minimum variance, the lowest standard deviation that is possible with the standard deviation history and return of these individual assets. So each of these assets, this may be IBM, this might be Apple, and so forth, right? Maybe this is Exxon over here. So we combine all of these assets or stocks, and maybe one of them is bonds we may choose, a fixed income security. Whatever assets we want to choose, software will seek to combine them to see what is the combination of those assets to give us the lower standard deviation, the lowest. And then these blue lines, this blue line here represents, excuse me, I got a little off there, all possible combinations of those 9 assets. So that's the kind of the magic of building an efficient frontier, and the magic of what software can do. Because can you imagine, and we could calculate how many combinations there are among 9 different assets. There are many, but computers do it very quickly and easily. And this slide summarizes what I went over in the recap, really, is that the optimal portfolio on the capital so let me start over there. The optimal portfolio is on that efficient frontier line, and it's at the tangent from the y-axis across that efficient frontier line, as I drew a little bit earlier. So there's something called the separation property, and it says there are 2 steps to identifying that. First, what is the optimal risky portfolio? That's a point on the line I showed you a minute ago. And then secondly, as we go down the tangency line to the risk-free asset, an investor would choose any point along that line that best suits their risk tolerance, which aka lowest standard deviation, or standard deviation that they're comfortable with. This expands our model from beyond a 2-asset portfolio to 6 assets, and these are all country funds. So in this case, we find that our minimum variance portfolio right here, a combined of percentages of each of these country funds, this minimum variance portfolio is achieved allowing short sales, and ended up shorting Germany and France. It also includes 70% of the United States fund in that mix. And then we have the no short sale line is right here, or point on the line. Actually, it's a point on its own efficient frontier, the black line here, and the blue line is with short sales. At any rate, this is our tangency line, this black line that parallels the red one I'm drawing here. And you can see that it intersects at 0, 0 on the XY, which is a risk premium of 0, which is where the risk-free would begin right here. And now, so the risk-free may have some return, right? It may have a 1 or 2% return right now, but that is not risk premium. So risk premium begins at 0. At any rate, it's interesting because utilizing this efficient frontier, everyone should use the same combination. The optimal portfolio is the optimal portfolio, right? So if you're going to allow short sales, then the optimal portfolio for everyone is right here. So the black line again is no short sales. That's with no short sales. So this little blue diamond here is the optimal portfolio because it's a point of tangency. The tangency line here that I drew alongside this is tangent to this black curve, the efficient frontier line at this point. And so all rational investors would choose this portfolio, except they would complete the portfolio, and the term is a complete portfolio. When an investor chooses how much of the risk-free, as I mentioned before, they want to add to this optimal. So this is the optimal risky portfolio right here with the arrow. But investors may say that's too volatile for me at this standard deviation right here. So they would begin to add some of the risk-free asset to lower that standard deviation. And the amount they lower it is an individual decision for each investor. Of course, we're talking about lowering standard deviation to make it less risky. And as we lower that, our return will fall as well. But investors got to work within a risk level that they're comfortable with. So there's a little terminology on this slide, something called an index model. And this is the idea of models, various models that might relate stock returns to returns on the broader market, such as the S&P 500, and relate them to that, as well as things that go on at individual companies that are unrelated to the overall stock market. So first of all, the stock returns on the broad market in excess. This excess return means excess over the risk-free rate. For the S&P, that's called the market risk premium. Market risk premium is the excess return over the risk-free rate for the S&P 500, which is just the proxy for the stock market. So, and there it is, rate of return in excess of the risk-free. Okay, and then beta. This is the Greek symbol for beta. And if we multiply, and beta is the sensitivity of a security's return to the overall stock market. So this excess return of the market risk premium, some companies are more sensitive to the movements of the overall market and some are less. So there's an old saw in the markets that a rising tide floats all boats. When the market's going up sharply, almost all securities go up. Well, that's because they are sensitive to the returns of the market. The market goes up, it pulls all up. If we have a crash, nearly all go down. So this sensitivity is measured with something called beta. So what percentage of this market risk premium does a particular company have exposure to? And then there's firm-specific risk, and in this book it's called residual risk. And it is independent of the market factor, and it is measured by alpha. And there's the Greek symbol for alpha. I'm giving you these symbols because they're going to show up in the next slide. And it is the expected return beyond that you would expect by beta multiplied by market risk premium. Any excess return over that is called alpha. And here's the formula that puts all of this together. The return on an asset I is the beta of I times the return of the market, or the excess return of the market, plus the alpha of I, plus any surprises, unexpected things that happen at the firm level that may cause the price of that stock to go up or down. For instance, I owned a Boeing when a couple of their MAX jets, their newest jets, crashed. And the stock price crashed as well to about half of what it had been before. Well, that was an unexpected event, firm specific. It didn't affect any other companies in the universe. Well, at least not maybe their suppliers. But anyway, that was an example of a new specific unexpected event. Yet another new term for you, the security characteristic line. And that's a plot of a security's predicted excess return, or alpha, from the excess return of the market. We can plot that.